Remember when altcoin ETFs were a pipe dream? When the SEC treated anything beyond Bitcoin like radioactive waste?
You're radioactive.
Well, welcome to 2025, where regulatory capture has reached such artistic heights that we now have ETF applications for penguin NFTs and presidential meme coins. Folks, the floodgates have been dynamited off of their hinges. Today, we dive into the spectacular circus that is the Altcoin ETF arms race, where filing fees are cheap, approval odds are soaring, and the future of finance has never looked so
entertaining.
My name is Nick, and you're watching The Coin Bureau. First things first, you need to know that nothing in this video is financial advice. It's just educational content intended to inform you about altcoin ETFs. If you want to keep learning about crypto, then be sure to smash that like button, subscribe to the channel, and ping that notification bell so you don't miss any of our videos. Now, just 18 months ago, mentioning Solana ETF in polite company would have you laughed out of the room. Now we have Bloomberg ETF analysts putting 95% approval odds on not just Sol, but XRP and Litecoin too. So, what changed? Simple. Trump won, Gary Gensler got the boot, and suddenly every 2-bit asset manager with a filing fee and a dream is rushing to trademark whatever altcoin ETF before someone else beats them to it. According to research tracked by Cointelegraph, there have been at least 31 spot altcoin ETF filings in the first half of 2025 alone. That's more altcoin ETF applications in 6 months than we saw in Bitcoin's entire first decade. The crown jewel of this regulatory gold rush just went live. Rex Osprey's Solana staking ETF launched on July 2nd, becoming America's first exchange-traded fund that actually pays you to hold crypto in the form of staking rewards, so don't get too excited. The ticker is SSK, and on its debut day, it pulled in $12 million in inflows with $33 million in trading volume. Not exactly BlackRock numbers, but for a product that was unthinkable under the previous administration, it's a solid start. But don't take my word for it. A Bloomberg ETF analyst Eric Balkunas said the staked spot Solana ETF had a, quote, healthy start to trading. He noted that it, quote, blows away the Solana Futures ETF, but was, quote, much lower than the spot Bitcoin and Ether funds when they launched. And that's the new barometer of success, not whether these products should actually exist, but how they stack up against the institutional cash vacuum that is IBIT. The really fascinating part about SSK isn't its performance, it's how it got approved. Rex Osprey bypassed the traditional 19B4 filing process that most other crypto ETF providers are still waiting on. Instead, they used what's called a 40 Act structure, which Bloomberg's James Seyffert described as, quote, very rare in the ETF world. It's basically regulatory arbitrage, use a different legal structure to avoid bureaucratic bottleneck. SSK holds roughly 80% of these assets in Sol, with about 50% of those tokens actively staked. The remaining 20% is held in liquid staked tokens and other Solana ETFs, which is kind of wild. The fund passes all of these staked rewards directly to investors, currently yielding about 7.3%. It's structured under the Investment Company Act of 1940, considered more favorable from a regulatory standpoint than the 1933 Act route most other applicants are taking. Translation? While everyone else is stuck in the traditional approval queue, Rex Osprey found a side door and walked right through it. Now that's innovation. But if staking Solana sounds too sensible for your tastes, don't worry. The industry has truly outdone itself with its next masterstroke: an ETF for cartoon penguin NFTs. On March 20th, Canary Capital filed an S1 form with the SEC for the Canary Pengu NFT, a fund designed to hold both Pengu tokens and Pudgy Penguin NFTs. If approved, it would be the first US-listed ETF to include NFTs alongside cryptocurrencies. The allocation? 80 to 95% Pengu tokens and 5 to 15% Pudgy Penguin NFTs, with some Sol and ETH thrown in for good measure. Let's take a moment to appreciate the ambition here. Pengu launched on Solana in December 2024, making it roughly 7 months old at the time of shooting this video. The token has, quote, very few identified use cases apart from a collector's item, according to Canary Capital's own filing. It's down roughly 90% from its January peak, and yet someone thought, you know what institutional investors really need? Regulated exposure to cartoon birds. The filing reads like performance art. Canary Capital explains they'll evaluate NFTs for the fund based on, quote, factors such as price, relative rarity, perceived desirability of particular NFTs' traits and characteristics, and the overall collection value. Imagine being the portfolio manager explaining to a pension fund trustee why you just bought a $100,000 NFT because it has a particularly desirable characteristic of its beak. Bloomberg's Eric Balkunas was suitably baffled, commenting, quote, this is the second ETF filing this week that I actually had to Google. Pudgy penguins? The community reaction on crypto Twitter was even less charitable. A 1x user summed it up perfectly. Quote, a Pengu NFT might be the dumbest thing I've seen lately. We don't even need ETFs for ghost chains, much less sub-6-month-old meme coins. But here's the thing about Canary Capital. They're not naive. A CEO, Stephen McClurg, is a former Valkyrie CIO who knows exactly what he's doing. ETF filings are relatively cheap. It costs around $100,000 to draft an S1. But the marketing value is enormous. Every filing generates headlines, social media buzz, and first-ever bragging rights. Canary has already filed for ETFs tracking Solana, Litecoin, XRP, Hedera, Axelar, and now SUI. That's 7 filings since Trump's election victory. By the looks of it, McClurg and his team have pivoted from building an investment company to building a marketing department with regulatory approval. The Pengu filing perfectly encapsulates what's wrong with this picture. It's not about serving investors or advancing crypto adoption. It's about exploiting regulatory arbitrage and media cycles for corporate gain. Speaking of gains, if you're looking to maximize your gains, you have to check out the Coin Bureau deals page. That's where you'll find sign-up bonuses of up to $100,000 on the best crypto exchanges, as well as trading fee discounts of up to 50% and cashbacks on deposits of up to 75%. These deals will not be around for long, so take advantage of them ASAP using the link down below. Back to the video. Now, while Canary Capital was busy trademarking cartoon penguins, something more significant was happening across town. On July 1st, the SEC approved Grayscale's conversion of its digital large-cap fund into a spot ETF, the first multi-asset crypto ETF in American history. The Grayscale Digital Large Cap Fund, GDLC, holds exactly what it sounds like. A market cap weighted basket of the top 5 largest crypto assets. The allocation is as follows at launch. BTC at 80.2%, ETH at 11.3%, SOL at 2.7%, XRP at 4.8%, and ADA at 0.81%. Total assets under management, approximately $755 million. ETF Store President Nate Garachi called this a potentially crucial precedent, noting that, quote, if a GDLC gets the nod, it could clear a path for single-asset spot ETFs tied to crypto assets like XRP, Solana, and Litecoin. His logic is sound because if the SEC approves a basket that includes SOL and XRP, it becomes much harder to argue that those assets are too dangerous for standalone ETFs. But here is where the story gets interesting. Just one day after approval, the SEC halted the conversion for review. According to a July 2nd letter, the agency's commissioners were reviewing the decision, which had been approved through delegated authority, meaning staff gave the sign-off without a full commission vote. This regulatory flip-flop perfectly captures the chaos of the current moment. On the one hand, you have staff-level approvals happening rapidly for products that would have been unthinkable 18 months ago. On the other hand, you have commissioners scrambling to maintain some semblance of oversight as their own underlings approve crypto ETFs faster than they can track. It revealed the tension within the SEC itself. Career staff freed from Gary Gensler's crypto shackles are approving products at breakneck speed. Political appointees are still trying to figure out what their actual policy positions are supposed to be. It's not quite the measured regulatory evolution we had in mind for the US crypto industry. It's more like regulatory whiplash driven by political winds. The numbers behind this approval frenzy tell their own story. Bloomberg analysts Eric Balkouris and James Seifert have raised their approval odds for multiple altcoin ETFs to levels that would have been absurd just a few months ago. You'll recall that Solana, XRP, and Litecoin now sit at 95% approval chances by year end. Well, Dogecoin, Cardano, Polkadot, Hedera, and Avalanche are at 90%. Seifert is expecting, quote, a wave of new ETFs in the second half of 2025, and predicts that spot XRP, Solana, and Litecoin products would be greenlit before year-end. The confidence is remarkable, given that most of these assets were considered unregistered securities by the previous administration just a few months ago. So, what's driving this optimism? Well, two key factors: political wins and regulatory streamlining. Trump's election victory and installation of crypto-friendly leadership at key agencies has obviously shifted the approval calculus. But there's also a more technical development that could accelerate the entire process. According to crypto journalist Eleanor Terrett, the SEC is reportedly exploring a simplified listing structure for crypto ETFs that would automate much of the approval process. Under the proposed system, ETF issuers could potentially sidestep 19b4 application filings entirely. Instead, they just need to submit an SEC Form S1 and wait 75 days. If the SEC doesn't object, the ETF gets listed automatically. And this would eliminate much of the back and forth between fund managers and regulators that currently creates these bottlenecks. It's essentially an approval by default system, exactly the kind of streamlined process that crypto companies have been demanding for years. The SEC has already shown this approach works in practice. In early July, the agency asked prospective Solana ETF issuers to respond to comments and refile amended S1 documents before the end of July. According to sources familiar with the matter, this suggests approvals could come much faster than the original October deadlines that have been floating around. All 7 asset managers seeking Solana ETFs, including Grayscale, VanEck, 21 Shares, Canary Capital, Bitwise, and Franklin Templeton, have updated their filings to include staking capabilities in response to SEC feedback. The fact that the SEC is providing specific guidance rather than just delaying indefinitely signals genuine intent to approve these products. But let's be real. Regulatory streamlining might as well be a euphemism for regulatory abdication. The SEC is essentially admitting it can't or won't evaluate these products on their merits, so it's defaulting to approval unless something obviously catastrophic happens. Obviously, this hands-off strategy could result in some big problems down the line, but it seems that the new SEC chairman Paul Atkins has no issues with this. And that's a bit scary when you consider that he voted in favor of relaxing rules around banks many years ago, a move that many have argued contributed to the 2008 financial crisis. More about that in the description. Now, of course, no altcoin ETF Goldrush would be complete without the Trump family's involvement, and boy, have they delivered. Trump Media and Technology Group, the parent company of Truth Social, has filed not one, not two, but 3 separate crypto ETF applications. The latest, filed recently, is called the Truth Social Crypto Blue Chip ETF. The allocation? 70% BTC, 15% ETH, 8% SOL, 5% Kronos, that's the Crypto.com exchange token, and 2% to XRP. This follows Trump Media's earlier filings for a Bitcoin-only ETF and a Bitcoin-Ethereum combination fund. All 3 products will be branded under the company's new fintech division, TruthFi, in partnership with Crypto.com. Chris Marszalek, Crypto.com's CEO, praised the collaboration for connecting his platform to, quote, a brand with a loyal following. Let's decode what's actually happening here. Trump Media is essentially licensing the Trump brand to Crypto.com for use in its ETF marketing. Crypto.com provides the back-end technology, custody, and crypto supply, while Trump Media provides the brand recognition and political connections. It's the same licensing model Trump has used for everything from stakes to universities. Slap the name on someone else's product and collect royalties. The Made in America branding is pretty ambitious, coming from a partnership with Crypto.com, a Singapore-based company that operates globally and was previously banned from certain US markets due to regulatory issues. But never mind the details. What matters is the marketing narrative. Trump Media's chairman Devin Nunes explained the strategy perfectly. Quote, "We aim to give investors a means to invest in American energy, manufacturing, and other firms that provide a competitive alternative to the woke funds and debanking problems that you find throughout the market." In other words, it's culture war investing. Buy our ETFs to own the libs. The timing isn't coincidental. Trump Media announced these ETF plans shortly after unveiling a $2.5 billion Bitcoin treasury strategy following the corporate treasury playbook pioneered by MicroStrategy. The company stock has been struggling, down more than 40% in 2025, despite Trump's return to the White House. So the crypto pivot makes perfect sense from a corporate desperation standpoint. Bloomberg ETF analyst Eric Balkunas was skeptical. Quote, "Despite Trump's brand, these will likely be microscopic in asset gathering compared to IBIT, FBTC et al. That said, just the fact they're launching it adds the mainstreamification narrative which matters." Translation: these products will probably fail commercially, but they'll generate headlines and political capital, which, let's be honest, is probably the point. So, it looks like crypto speculation is becoming institutionalized on Wall Street faster than we thought possible. It's slightly unnerving to think that the same Wall Street machine that packaged subprime mortgages into AAA-rated securities is now jamming meme coins into regulated investment products. The Rex Osprey Solana fund is genuinely innovative, offering something new to investors who want yield-bearing crypto exposure. But the Pengu NFT fund, the Trump-branded basket of politically aligned tokens, these aren't investment products, they're marketing stunts with expense ratios. The bigger question is what this rush to approve everything means for the future of crypto. No doubt we are going to see some crazy price action unfolding if top-signal headlines like these keep coming out. You have to wonder though, when pension funds can buy exposure to Pengu through their existing brokerage accounts, has crypto been adopted or has it been domesticated? The staking element adds another layer of complexity. SSK's ability to pass through staking rewards to investors is genuinely beneficial. It eliminates the need for individual investors to manage validators, custody, and technical operations. But it also means that professional fund managers, not token holders, are making governance decisions about network upgrades and validator selection. As more staking ETFs launch, and the SEC has signaled openness to Ethereum staking as well, we could see meaningful portions of proof-of-stake networks controlled by a handful of asset managers. BlackRock already controls massive portions of corporate America through its index funds. Do we want them controlling crypto networks too? The approval odds that Bloomberg analysts are citing, 95% for major altcoins, reflect a regulatory environment that has swung from hostility to capture in record time. For years, the industry was crying out for evidence-based policy making, but what we have received is something closer to political theater. So, where does this leave us? Well, the Altcoin ETF Goldrush is very real. Solana staking funds are already trading. Multi-asset baskets are on the brink of approval. Pengu and Pudgy Penguin's NFT exposure is apparently around the corner. The only question is whether this represents genuine progress or institutional co-option. The optimistic view is that regulated access will drive adoption, legitimize crypto assets, and ultimately benefit the entire ecosystem. More money flowing into crypto, even through institutionalized channels, should theoretically benefit all holders. The pessimistic view, though, is that we're watching crypto's final surrender to the traditional financial system. When JPEGs of cartoon penguins can be packaged into registered investment companies, when presidential meme coins get ETF wrappers, when yield farming becomes just another institutional service, what exactly makes crypto different from any other speculative asset class? The truth, as usual, probably lies somewhere in the middle. Institutional adoption was always inevitable, and some of these products, particularly staking ETFs, offer genuine utility to investors who want crypto exposure without technical complexity. But the sheer number of applications, the political nature of many products, and the speed of regulatory approval all suggest an environment driven more by opportunism than by thoughtful development of crypto infrastructure. Bloomberg's James Seyffert aptly said of the Pengu filing, quote, "The low filing cost explains the flood, but actual approval, that's a whole different story." Except it's increasingly looking like approval isn't a story at all. When regulators are defaulting to yes unless something is obviously catastrophic, the bar for catastrophic becomes the only meaningful filter. We're about to find out whether institutional crypto adoption looks like sophisticated financial innovation or just another Wall Street bubble machine applied to a different asset class. For now, though, the penguins might be telling us the answer. Keep your eyes on those October deadlines, though. If Bloomberg's analysts are right about those 95% approval odds, the second half of 2025 is going to be very interesting indeed. As usual, the most entertaining outcome is probably the most likely. Welcome to peak institutional crypto adoption. And if you want to learn more about how deep Wall Street is into crypto nowadays, why not check out our latest report on institutional adoption of RWA cryptos right over here. And if you're not subscribed to the channel yet, well, you can do that right over here. This is me, Nick, signing off. Thank you guys very much for watching, and I'll see you in the next video.